to Iron Financial. This is the place where we forge stronger portfolios by putting companies under some serious pressure. I'm your lead analyst, and as always, the man keeping us honest, our market skeptic. Today, we are putting an industrial titan on the anvil just hours before it reports earnings. Fastenal, ticker FAST. Now, on the surface, the market sees a simple story, right? It's a story of growth, of dominance. But we see something else. We see an internal battle raging inside this company, and you better believe the outcome of that fight is going to define Fastenal's future.
Look, Fastenal is basically the circulatory system for the entire industrial sector. They provide the nuts, the bolts, the critical components that keep America's manufacturing heart beating. And because of that, it looks like an impenetrable fortress. But with an earnings report just around the corner, that one moment where every single number gets put under a microscope, we have to ask the question that you should be asking about every stock in your portfolio. Is the foundation really as solid as it looks, or are there hidden cracks, tiny fractures starting to form under all that pressure? Well, we're about to find out. This isn't just another pre-earnings preview. No, this is a full-blown Iron Financial stress test.
All right, so here is how this stress test is going to go down. First, we're going to do the work of the bulls. We will forge the most compelling case for Fastenal that the data allows. Then I'm going to step in and start hammering on the headwinds, looking for every single weak point. After that, we're going to zero in on the margins, because that is the heart of this entire conflict. Then we'll look at the hard data from the Zacks model to see if we can break the tie. And finally, we will deliver our Iron Financial verdict. Let's get to it.
Okay, let's get our hands dirty. First things first, we enter the forge. Right now, our job is to build the most robust, the most steel-framed argument possible for Fastenal's fundamental strength. We're pulling these numbers directly from the consensus estimates in our source material from Zacks. This is the narrative that the bulls are telling themselves. And to be perfectly honest with you, it starts with some seriously heavy-duty numbers. This is us laying the foundation for the bull case piece by piece.
So what's the cornerstone of this whole argument? It's this number right here, a 12.2% year-over-year revenue growth projection. That brings their total sales to a massive $2.2 billion for a single quarter. Now, stop and think about that for a second. In today's market, in an industrial landscape that is, let's be honest, volatile, with supply chains still a mess and whispers of a recession always on the horizon, in that environment, securing double-digit growth is an incredible show of force. This number doesn't just tell you Fastenal is holding its own. No, it tells you it is actively taking market share. It's conquering new territory from its weaker competitors. This, right here, is the main load-bearing pillar of the entire bullish argument.
Now, here's where the story gets really compelling. What you're seeing here is that the good news doesn't stop at the top line. It actually gets stronger as you move down the income statement. A 12.2% growth in sales is fantastic, don't get me wrong. But look at what it translates to on the bottom line. An even more impressive 15.4% estimated year-over-year growth in earnings per share. For you, the investor, this is absolutely crucial. It means the company isn't just selling more stuff. It's actually becoming more profitable on every single one of those increased sales. You're seeing real operational leverage working in their favor. This isn't just an engine that's running, you see. It's an engine that is running with increasing efficiency, and that is what drives shareholder value over the long term. And if you need any more proof, this chart shows you all you need to know. What you're looking at is undeniable, accelerating momentum. This isn't just a lucky quarter. A year ago, their daily sales were sitting just above $31 million. Pretty good. Last quarter, they took a solid step up to $32.2 million. But just look at the estimate for the quarter they're about to report. We are talking about a staggering leap to nearly $37 million per day. Let me be clear, that is not a gradual, gentle climb. That is a powerful surge. This machine is gaining speed, it's not losing steam, and you can be absolutely certain that the market is paying very close attention to this kind of velocity.
So the natural question is, what in the world is fueling this incredible acceleration? Well, it's definitely not luck. It's a very specific combination of precise strategic moves. Our source material lays it out pretty clearly. They are absolutely crushing it with their large national account customers. But their real competitive advantage, I'd even call it their secret weapon, lies in their on-site solutions. We're talking about their Fastenal Managed Inventory Tech, FMI, and of course, their famous industrial vending machines. They are literally embedding themselves, becoming part of the plumbing of their customers' operations. Think about it. They're putting a tiny Fastenal storefront right on the factory floor. That creates an unbelievably sticky relationship and a moat that is almost impossible for a competitor to cross. And when you throw in some targeted pricing actions on top of all that, you get the revenue explosion we just saw. So when you put all of those pieces together, you take the double-digit revenue growth, you add in the even stronger earnings growth, you see the proof of accelerating daily sales, and you understand the clear strategic drivers behind it all, well, the bull case becomes almost overwhelming. The top line doesn't just look strong, it looks like a fortress. And based on this data alone, the argument is that Fastenal is nothing short of an unstoppable force in the industrial sector. Hold on. A fortress always looks impenetrable when you're looking at it from a mile away. But here at Iron Financial, we don't just stand back and admire the pretty architecture. We bring out the anvil. It is my job to take a hammer to this beautiful structure you've built and test for any cracks, any hidden weaknesses, any sign at all that this fortress isn't nearly as strong as it appears. It's time to see if this bull case of yours can actually withstand some real honest-to-goodness pressure. Those are some impressive top-line numbers, I'll give you that. It's a really good story. But history is filled with examples of strong walls that were just concealing a decaying, rotting interior. My number one concern is what's happening inside this fortress. Is the operational core, the heart of the business, as strong as those flashy sales figures suggest? Because let's be real, sales are only one part of the equation. Profitability, that's where you find the real vulnerabilities. That's where you find the stress points. And that, my friend, is where this simple story gets a whole lot more complicated. And the first hairline crack in your fortress appears the second you zoom out and look at the bigger picture. The source material is very direct about this, and I quote, "The broader industrial environment remains uneven." What does that mean? It means industrial production has been, for the most part, flat. Now, that might not immediately hurt those big, powerful national clients you were just bragging about, but what about everyone else? Fastenal still serves literally thousands of smaller, non-contract customers, and those are the businesses that get squeezed first when the environment gets tough. They are way more sensitive to these macro headwinds, and the softness there could be a significant drag that the headline growth numbers are conveniently hiding from view right now. That's a completely fair point, and it leads us directly to the absolute white-hot center of this entire analysis. The real battleground for Fastenal going into this earnings report. It isn't about sales growth. We've already established that's rock solid. The entire story, the whole debate that analysts and investors are having right now, it all hinges on the battle being waged over the company's margins. This is the core conflict. This is where the bull and bear cases smash into each other head-on. It's a classic fight between top-line growth and bottom-line profitability. Right. And this slide really lays bare the core paradox of Fastenal's entire strategy. I call it the customer growth paradox. On the one hand, just like you said, their ability to sign these huge multi-site contracts is their greatest strength. It is what fuels that impressive sales growth we saw. But on the other hand, and this is the dangerous part, this very strength is also a significant structural weakness. Why? Because these massive clients have incredible negotiating leverage. They demand, and they get, lower prices, which directly eats away at gross margins. So this means that for every major sales victory they celebrate, there's a corresponding, and potentially dangerous, hit to their overall profitability. The market falls in love with top-line growth, but it often ignores the cost, and that sets up a potential valuation trap for investors who aren't paying attention. And the pressure on their margins, it doesn't just stop there. This is not a single, isolated issue. Take a look at this list, pulled straight from the source material. We're seeing a persistent, ongoing mix shift toward these lower-margin customers. We've got volatility from things like supplier rebates, the discounts they get for buying in bulk, which are not always predictable quarter to quarter. There are potential inventory costs lurking. But honestly, the most concerning point on this entire list is the last one, a neutral price-cost dynamic. This means that those strategic pricing actions that we were praising just a few minutes ago, well, it turns out they're just keeping pace with inflation. They aren't actually driving any new profit growth. They are running harder and harder just to stay in the same place. Each one of these factors is another hammer blow to the company's bottom line. All right. The battle lines are now very clearly drawn. On one side, we have an undeniably powerful growth engine, a fortress of sales. On the other side, you argue, that fortress is under siege from some significant and persistent margin pressures. It's a classic tug of war. So how do we break the tie? Well, this is where we turn from the qualitative story to the hard data. We are now going to look at the quantitative output from the Zacks proprietary model, as cited in our source, to see which way the numbers themselves are actually leaning. Now, before I just flash the results up on the screen, it is critical that you understand what we're looking at here. These are not just some arbitrary rating someone cooked up. The Zacks rank is a system that quantifies the momentum in earnings estimate revisions from Wall Street analysts. So an improving rank means that expert sentiment is getting stronger. Then there's the earnings ESP, which stands for Expected Surprise Prediction. This is even more specific. It hones in on the difference between the overall consensus estimate and the most accurate, most recent estimates. A positive ESP is a very strong historical indicator that the smart money is positioning for an earnings beat.
So, what does the model actually predict for Fastenal? Well, the results are pretty definitive. First off, the Zacks rank is in number 2, which in their system translates directly to a buy rating. That tells us right away that the overall momentum in earnings revisions is positive. But more importantly, the earnings ESP is a positive 2.15%. So here's the bottom line. Despite all of the completely legitimate margin headwinds that the Skeptic just meticulously laid out, despite all that pressure, the quantitative model is flashing a clear, unambiguous signal it is predicting a high probability of an earnings beat. The data suggests that, at least for this quarter, the growth engine is winning the war against margin compression.
And there you have it. The qualitative story, the narrative, points to a really serious conflict raging over the company's margins, but the quantitative model is predicting a clear win for the bulls. So this is the point where pure analysis turns into judgment. It's time for the final temper. We have heated the metal in the forge, we've hammered it on the anvil. Now we cool the steel, we see how it holds its final shape, and we deliver the iron financial verdict. This quote right here, it perfectly encapsulates the entire conflict we have explored today. On one side, you have that rock-solid growth engine. It is an undeniable force in its industry, period. On the other side, you have these very clear signs of internal friction on its margins. So with the earnings report just hours away, the entire investment case, everything, boils down to one single critical question. Which of these two opposing forces is stronger right now? Is that top-line momentum powerful enough to just blast right through the profitability headwinds? So after putting Fastenal through the forge, after testing it on the anvil, the final iron financial verdict is this. Fastenal is a structurally sound company, but, and this is a huge but, it is unequivocally showing signs of stress. The top-line execution is simply best in class. There's no debate whatsoever that they are taking market share and that their on-site strategy is a powerful, long-term competitive advantage. However, and this is the part you cannot ignore, those margin headwinds are not just temporary noise. They are a legitimate structural concern. The foundation is solid, but we are seeing visible cracks forming in the concrete. The fortress is still standing, but the walls are absolutely being tested.
And that leaves us with the final ultimate question that you, as an investor, have to answer for your own portfolio. With the earnings report just hours away, you have to decide what this margin pressure truly represents. Is it just a minor crack that a strong earnings report can easily patch over? A temporary issue in what is a fundamentally sound structure? Or is it a sign of a much deeper foundational problem that's about to break wide open the second those numbers hit the tape? The answer to that question is going to determine whether Fastenal stock is a massive opportunity or a dangerous trap right now. Here at Iron Financial, we provide the stress test. We provide the framework. It's your job to use it to forge your own strong portfolio. We'll see you next time.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.